I'm G.Sean Williams, Executive Director for SMS-Advisors and Board of Directors member for ISM Carolinas, Virginia. I want to talk about financial statements. I know we talk about finance and we get a little nervous as professionals because we're talking about numbers and we're not as knowledgeable as we like to be. But this segment is going to give us a little bit more power so we can speak more confidently about financials. The first thing that we need to know is that there are 4 types of financial statements that we should care about for the most part. Now, there are many different types of financial statements. There are 4 types that we're going to focus on. There is the income statement, which is also called the P&L or profit and loss. There's the balance sheet. There's the statement of retained earnings, and then there's the cash flow statement. For our purposes today, we're going to focus on the income statement, or what's also called the profit and loss. Let's talk about why it's important for us to care about the income statement. Let's focus on our organization first. If we look at our organization, one of the things that we care about on the income statement is how do we actually contribute to the margins of our company? How would our cost savings impact the growth of our company, whether it's in what we'll learn a little bit later, direct costs or operating expenses. And we think about our supply base. It's really important for us to get an understanding of the financial strength of our supply base. And one of the ways that we can do that is by getting a general understanding of their income statement. So let's go to the whiteboard and let's break down the income statement so we can see it, and seeing is believing. Here we are at the whiteboard. We're going to break down the income statement. The income statement may also be called the P&L, or the profit and loss. If you're working with a department or business unit, they may call it their budget or their operating budget. So our operating budget, our P&L, our income statement, they may all be synonymous to a certain extent. So what we're going to do is we're going to look at a high level income statement so we can get a feel for what's inside of it. Okay, guys ready? Let's look at an organization. It could be our supplier, or it could be one of our business units, but let's say that whatever this organization is, their revenue is $20 million. So we're going to call this revenue, but keep in mind that it may be called income, and it could also be called sales. So let's go ahead and make a note. All right, so we have that and we're happy there. But then there's a whole bunch of stuff that you need to buy or source in order for you to make $20 million. So let's use mattresses, for example. We need to buy the lumber, spring sets, fibers, and all the other things that would go inside of a mattress or a box spring. That collection of items would be called our direct materials. We also have the people in the manufacturing facilities that actually have to put that mattress together. Those people would be part of our direct labor. So we have direct costs that's made up of direct materials and direct labor. In our example, we will use $12 million. $12 million of direct cost, which, just to make sure we're on the same page, could be labor and material. There's another name for it that I want to make sure you are aware of. It also could be called COGS, C-O-G-S. What that stands for is cost of goods sold. So let's just write that there so we have it, or cost of goods sold. Okay, it's not confusing, so I'll just repeat it one more time. Direct costs is very similar to COGS. Both of those will have an element of direct materials and direct labor. So in our example, we spend $12 million on COGS. What we have to do now is we have to subtract the 12 million from 20. So we're going to subtract. That gives us 8 million if you're following on a sheet of paper. That 8 million is something. That 8 million for us would be our gross profit. That gross profit is very important because it gives us a general feel for how we're performing versus our competitor, or how your supplier is performing versus their competitor. So we have 8 million of gross profit, but our financial friends, they like to use all of these terms. So we're going to turn this into a term that they like, which is gross margin. All right, how do we do that? We actually are going to take the 8 million and we're going to divide 20 million. So 8 divided by 20 million is going to give us 40%. Or in other words, we have a 40% gross. Gross margin in this situation. Okay. Now we can go back and look at the direct costs. Okay, well, then it's very obvious. Our direct cost is 60%, and our checks and balance would be 12 divided by 20. So I'm just gonna make a little note here. So you get into a conversation with your CFO, you say, oh yeah, our COGS are 60%, and obviously our gross margins are 40%. That equals 100%, or it equals your revenue, or income, or sales. All right, so we got it. Now let's go a little deeper. Let's go a little bit deeper. If we have that, we're gonna go deeper now. We have these things, the other stuff that we have to buy or procure, etc. It could be our building or janitorial services. It could be people. It could be the computers that we use. So let's categorize them into some typical categories. Now, it may not be the same at your company or for your supplier, but we're going to use some very generic categories. The first one we're going to use is overhead. And it's really interesting because it's what's over our head for the most part. It's our building. It could be the utilities that we pay for to make our building run. So let's use those two. For example, we're going to give ourselves, let's say, $2 million in overhead. Okay, so we got that. We got some other stuff. All right, so remember when we walked in to the building and security greeted us, and the grass was nice and green, and there was flowers, beautiful spring day. We also had food, so at lunchtime we went down to cafeteria services and we got food. We had vending machines, we got, oh, it's warm in here, or it's cool in here, so that's our HVAC. All of that stuff could be part of general expenses. So we're gonna give ourselves $3 million in general expenses. Sorry, I'm left-handed, so if I'm in your way, I apologize. Now we got $3 million of general expenses. There's one more thing that's left that I definitely want to address. That would be administrative expenses. So it could be our sales group. It could be how much money our sales group spends to take our clients out to dinner. It could be, wait a minute, it could be us. It could be procurement. Procurement, supply chain will fall under administrative expenses. It could be finance. All right, so usually when our company, or have you ever heard a CFO or a CEO talk about reducing their cost basis through attrition or laying people off, they're generally talking about the administrative costs. They could be talking about direct labor as well, but usually there's a lot of executives that take packages, and when you see that, then that will be the administrative cost. Some people call it SG&A. So these terms hopefully are all familiar to you now. We're putting them all together. So we're going to give ourselves $2 million in administrative expenses. Okay. I'll give you a second to catch up if you're writing this down at home. All of these equate to something. So, well, we got to figure out the number that it equates to first. 2 plus 3 plus 2 equals 7. So all that equates to 7 million. That's 7 million. It can be called many different things, but at most organizations, I'll try to use a generic term, total operating expenses. Okay, total operating expenses. If we take this 7 and we subtract it from this 8, we get a number. That number will be 1 million. What is that number? I can't hear you. I'm just joking. What is that number? That number is net profit. And I'm going to be technical. Let's turn that into a percentage. So we want to get our net margin in this situation. We're going to take $1 million and divide $20 million. So 1 divided by $20 million is going to give us 5%. So that means that we have 5% net margins. We are almost done. There's a little bit of extra credit that we're going to get here. We're going to go to distance. There are 2 other things that are important to us when we talk about the income statement. One of them would be EBIT. The other one is going to be EBITDA. Before I go there, we're going to title this thing so we know what we're doing here. This is our income statement. And let's just call it 101 because we're learning, right? It's our income statement 101, and it's also possibly called a P&L. It also could be an operating budget. We also could use this to forecast, whether we're forecasting our suppliers' financial strength, or we're looking at our business unit or our company. So we can do a lot of different things with this framework. For the most part, we're using it as an income statement or an operating budget to work with our business units. All right, with that being said, I'm going to get to EBIT and EBITDA, I promise you. But with that being said, I want to do one more thing. I want to point out where procurement has the largest impact inside of an organization. So when we talk about direct materials, those are the things that typically we're buying. We're buying in the mattress industry fibers, we're buying lumber, springs, all of the things that we would use in a mattress. We also have a pretty large impact with general expenses. We are buying janitorial services, we're buying cafeteria services, we're making sure that our teams have computers. Maybe it's marketing materials for our sales group. So these are all of the things that we are buying and securing and writing contracts for and working with our suppliers to make sure that they perform. I promise you EBIT and EBITDA. We probably got to understand what that means first, okay? So we have earnings before interest and taxes. Now, earnings, I know it's a little tricky. That net profit that we talked about also could be our earnings. So let's just go ahead and put that in parentheses there. So it would be how much money do we earn before we had interest and taxes? So what it means is that interest and taxes are already paid for inside of these things. If we bought products from a supplier and there was taxes included, then of course that would be part of our general expenses. If we had taxes included, let's say inside of our payroll for administrative expenses, then it would already be inside here. So what we're trying to do here is we're trying to understand what was our earnings before we had interest and taxes. And then there's another one here, which is EBITDA. So you guessed it right, this is the same. Earnings before interest, taxes, depreciation, and amortization. Or in other words, I want to know my net profit, or what my profit would have been if I did not have inside of here interest, if I did not have inside of there taxes, if I did not have inside of there depreciation, and if I did not have in there amortization. So I'm going to do one last thing before we wrap up this segment. We understand interest. That's how much money we pay on a loan in interest, or the rates that we get. That's on top of the principal. We understand taxes. That's payroll taxes, it's FUTA, SUTA, FICA. It could also be sales taxes. Okay, so we got that. We also, depreciation, yeah, that's where we get a little shaky, right? What is depreciation? What is amortization? So really quickly, I'll start with depreciation. Whenever we purchase a asset, we typically have to depreciate that asset. So this may be familiar to you when you think about your house. If you've bought a house before, you typically have to depreciate that house over time. It's capital equipment. Our companies and organizations have to depreciate capital equipment. Our cars, they depreciate when we buy cars. Cars are assets. So these are all things that are going to depreciate, and we have to count the depreciation inside of our total operating expenses. We also count amortization. When we take out a loan, for example, we're going to have an amortization table. You may see this with your real estate. So you have to pay back $500 a month for 12 months. So if that was the case, we have $6,000 in amortized fees or amortization costs for that year. Okay, so at the end, why is this important? Because I want to look at how my supplier is performing, how my business unit is performing, how my company is performing, but I also want to get an apples to apples comparison for how my company may look in comparison to one of our competitors. And I can't do that if our loans are more, if we depreciate it more because we have more assets. What I want to do is get the real numbers. So after I have a full income statement, I would then go back in and try to find my EBIT and EBITDA. I hope this was helpful. Remember, finance is not that difficult when we understand how the numbers are generated or where the numbers have come from. But before that, an outline of what we're looking at. So please feel free to find us at www.psmtrainingsolutions.com if you're interested in any of our upcoming live training programs or some of our online offerings. Good luck.